Welcome to the Opening Bell Report.
Stop what you are doing for a second.
Yeah.
We need to talk about the number 127.
It sounds like a random integer, doesn't it? Maybe a highway exit or an error code on your computer.
Right.
But in the context of the analysis report we are looking at today, 127 isn't just a number. It is, frankly, statistically offensive.
Statistically offensive. I like that. We are diving into a stack of documents regarding Palantir's Q4 performance. And to set the stage for everyone listening, I had to double-check my own notes on software economics before we hit record.
Yeah.
Usually, in the SaaS world, software as a service, there is a magic number that every CEO prays for.
Right, yeah.
It's 40.
The famous rule of 40, it is the golden standard. I mean, if your growth rate percentage plus your profit margin percentage equals 40, Wall Street pops the champagne.
You're elite.
You are elite. You are a top-tier stock.
Right. So 40 gets you a pat on the back and a high valuation. 50 makes you a superstar.
Yeah.
And yet, we are looking at this report for Palantir, and they didn't hit 40.
Nope.
They didn't hit 50.
Yeah.
They didn't even hit 60.
They hit a combined score of 127.
127.
Which is effectively breaking the scale. It's an anomaly in the truest sense. If the rule of 40 is a final exam, Palantir didn't just get an A+. They scored a 300% and then started grading the teacher's paper.
So our mission today is to figure out if this is actually real. Because for the longest time, the narrative around Palantir was the exact opposite of this. Critics called it a black box consultancy.
Right.
The bear case was always great tech, cool spy stuff, but they can't scale. It requires too many humans.
Exactly. The criticism was that Palantir wasn't a software company. It was a services company masquerading as one.
Yeah.
You know, you hire them and they send an army of forward-deployed engineers to your headquarters to fix your data manually. That's a low margin, hard to scale, and investors hate it because it doesn't compound.
But this recent report flips that narrative on its head. We aren't looking at a consultancy anymore. The analysis describes this new version of Palantir as an efficient software money printing machine.
And the market is reacting violently to that realization. The share price mentioned in our sources is sitting at $157. But the question we need to answer is, how? How do you mathematically get a score of 127? Is it accounting tricks? Or have they fundamentally changed the physics of their business?
And perhaps most importantly for the listeners holding onto their wallets, is this valuation a bubble waiting to burst, or is $157 actually cheap?
That is the multi-billion-dollar question.
Okay, before we get too excited about the triple digits, we need to eat our vegetables. We need to break down the rule of 40 so we understand why it's so hard to beat.
Right.
I'm not a CFO, and most of our listeners aren't either. Why is 40 the limit? Why can't everyone just hit 100?
It comes down to the fundamental tension of business physics, the trade-off between growth and profitability.
Walk me through that tension.
Okay, so think of a software company like a high-performance car. If you want to accelerate, that's your revenue growth, you need to slam on the gas. In business terms, gas is sales and marketing spend. You hire expensive account executives, you buy Super Bowl ads, you fly people to conferences, you offer discounts, you are burning cash to acquire customers.
So logically, high growth usually equals high cash burn. Your margins go negative because you're spending everything to get bigger.
Precisely. That's the classic Silicon Valley startup model.
Yeah.
Growth at all costs.
Yeah, we've seen that movie before.
You might grow 60% year over year, but your margin is negative 20%. So 60 minus 20 equals 40. You pass the rule, but you're bleeding money to do it.
Okay, and the other side of the coin?
The cash cow mode. You stop spending on marketing, you fire the expensive sales team, you focus on efficiency.
Yeah.
Your growth slows down to, say, 10%, but your profit margin shoots up to 30% because you aren't spending anything. 10 plus 30 equals 40.
So usually the math forces you to pick a lane. You're either a rocket ship burning fuel, or you're a slow-moving cargo ship carrying gold.
It can't be both.
You can't be both.
Exactly. It is incredibly rare to find a company that can accelerate the car while simultaneously filling up the gas tank. That's what Palantir just did. They defied the trade-off.
Let's look at the specific numbers from the report because they are jarring. First, the growth.
Their revenue grew 70% year over year.
70. Which is wild contextually because historically Palantir was hanging out in the 20% growth range.
Right.
So this isn't a small bump, this is a massive acceleration.
A massive acceleration. So you start with a score of 70. Now, usually with 70% growth, I would expect their margins to be deeply negative. I'd expect them to be burning cash like crazy to fuel that expansion. Instead, their free cash flow margin hit 57%.
57% positive margin.
Yes, for every dollar they bring in, 57 cents is hitting the bank account as free cash flow.
That just doesn't make sense. How do you grow at 70% while running a 57% margin? That's better than most utility companies.
70 plus 57 equals 127. That is the impossible number. They aren't treating growth for profit. They are maximizing both simultaneously. And Just to be clear on terms here, when we say free cash flow, we aren't just talking about accounting profit. We are talking about liquid cash generated by the business after paying for operations and capital expenditures.
So they are drowning in cash.
They are. And that liquidity gives them options that their competitors just don't have. They can acquire, they can invest in R&D, or they can just sit on a fortress balance sheet.
Context is king here, though. 127 sounds big, but I want to see the scoreboard. Who are they playing against?
Good question.
When we talk about cloud data darlings, we usually talk about companies like Snowflake or Datadog. These are the Wall Street favorites. How do they stack up?
The analysis uses a great phrase for this. It says Palantir is playing a different sport.
Let's check the tape. Start with Snowflake. Ticker SNOW. A couple years ago, they were the hottest stock on the planet.
Oh yeah, they were everything.
Everyone wanted a piece of Snowflake.
Right. Snowflake is a fantastic company, but they are currently struggling with the law of large numbers. Their growth has slowed to about 30%.
Okay, 30% is respectable. It's not 70%, but it's not zero.
It is respectable, but their margins, their free cash flow margins, are hovering around 11%.
So 30 plus 11, that's a score of 41.
They are barely clearing the bar. They are technically elite by the rule of 40 definition, but they are hanging on by their fingernails.
Just passing the class.
They're just passing the class.
Okay, what about Datadog? They're usually seen as best in class for efficiency.
Datadog is much stronger. They have about 28% growth and remarkably consistent 28% margins.
But that's a score of 56.
The score of 56 is objectively great. In any other quarter, we'd be doing a deep dive on how amazing Datadog is.
Right.
A score of 56 puts you in the top 1% of software companies, but then you put that 56 next to Palantir's 127.
It makes the elite look mediocre. It's more than double the score. It's like a basketball team winning 280.
And that gap explains the valuation premium. Investors aren't stupid. They see this divergence. That's why Palantir trades at such a high multiple. The report mentions their PE ratio, price to earnings, is sitting at 249x.
Well, I want to put a pin in that number because 249x is terrifying to a value investor. The S&P 500 average is what, 20, 25?
Oh, yeah, on there, yeah.
So you're paying 10 times the market average for this stock. That feels like a nosebleed valuation.
You are, but the argument is that you are paying for an anomaly. You're paying for a company that has seemingly broken the iron law of sauce trade-offs.
Okay.
If you believe the 127 score is sustainable, then 249x might actually be cheap. If you think 127 is a fluke, then the stock is wildly overpriced.
This brings us to the most critical part of the investigation, the how. You don't just wake up one morning and triple your growth rate from 20% to 70% while simultaneously cutting costs.
Yeah.
That requires a fundamental operational shift. What changed inside Palantir?
The report identifies a specific engine for this acceleration, and it's not just AI. It's the distribution mechanism for AI. They call them AIP boot camps.
I've heard this buzzword floating around. AIP stands for Artificial Intelligence Platform. But what is the boot camp in this context? Is it a training seminar? A workshop?
It's a sales revolution. To understand why it matters, you have to look at the old Palantir sales cycle. Think about how they used to sell Gotham or Foundry to governments.
High friction, heavy security clearance, long dinners, a lot of hand-holding.
Exactly. A classic enterprise sales cycle takes 6 to 9 months. You have to find a champion, do a demo, negotiate with procurement, run a pilot program, wait for legal. It is a slog.
And it's expensive.
So expensive. You're paying sales commissions that whole time. You're flying people out. That eats your margin alive.
That's the customer acquisition cost, or CAC, that kills profitability.
Right. Now look at the new Palantir with these AIP boot camps. The analysis says they are converting customers in 1 to 5 days.
Wait, slow down. From 9 months to 5 days.
That is the claim, and here is how they do it. They don't send a salesperson with a PowerPoint deck promising what the software could do.
Okay.
They bring the customer's engineers into a room, they take the customer's actual data, and they build a working solution on top of AIP right there.
Hands-on keyboard.
Hands on keyboard. By the end of the boot camp, sometimes just 10 hours later, the customer isn't looking at a brochure. They are looking at a deployed application solving a specific problem they have.
So the product sells itself. It removes the trust barrier because the proof is right on the screen.
It's show, don't tell, weaponized. The report calls it product-led growth on steroids. And think about what that does to the math we discussed earlier.
If I don't need a salesperson working the account for 9 months, my cost of sales plummets. I don't need to pay for 9 months of dinners and flights.
And your margins explode. That is where the 57% free cash flow margin comes from. They aren't just selling more, they are selling differently. They've cracked the code on how to sell complex enterprise AI with the speed of a consumer app.
That's a fascinating insight. It's not just that the tech is good, It's that they found a way to bypass the bureaucratic nightmare of enterprise procurement. They make the value undeniable in 48 hours.
And they are doing it at scale. They are running hundreds of these boot camps a month. The bottleneck isn't finding customers anymore. It's finding enough Palantir engineers to run the sessions.
Okay, so the engine is real. The boot camps are working. But I have to play the skeptic. We mentioned that PE ratio of 249x.
Right.
Even with a great engine, that is a lot of future expectation baked into the price. If they miss earnings by a penny, this stock could get cut in half, couldn't it?
Oh, absolutely. That is the risk. The bears look at 249x and scream, bubble. They argue that no company can grow into that valuation fast enough.
And they would normally be right.
And if Palantir were growing at a normal good rate of 15-20%, the bears would be 100% right.
But the analysis offers a bull rebuttal.
It does. And it relies on a metric called the PEG ratio, price earnings to growth.
Walk us through the logic there, because PEG is a bit more nuanced than just PE.
The PEG ratio basically asks, is the high price justified by the speed of the growth? A PE of 200 is insane if you're growing at 10%. But if your earnings are doubling or tripling every year, that E in the PE ratio gets bigger so fast that the multiple collapses naturally over time.
So you're essentially paying upfront for earnings that are going to arrive in the future.
Exactly. The argument is that Palantir's earnings are compounding so violently driven by that 127 score efficiency that the stock is actually cheaper than it looks. You aren't buying 2024 earnings, you're buying the exponential curve of 2026.
Okay.
The PEG ratio attempts to normalize the price against that growth speed.
Let's talk price targets then. The report mentions the stock was around $157 at the time of writing. What are the experts seeing?
The Wall Street high watermark, specifically from Piper Sandler, is set at $230.
Wow.
That's a roughly 50% upside from here.
That's aggressive.
It is. But the analysis in our source goes even further. The prediction is that if Palantir can hold this Rule of 40 score, if they can prove that 127 wasn't a one-time fluke, the price could cross $200 before summer.
That relies entirely on consistency. 1 quarter is a blip, 2 quarters is a coincidence, 3 quarters is a trend.
Correct. And markets love trends. If they print another quarter of a 100-plus score, the skepticism will evaporate.
There's one more layer to this onion, and I think it's the most important one for the long-term investors listening. The report mentions something called the NVIDIA moment.
This is my favorite part of the analysis because it zooms out to the macro economy. Think about the last 2 years in tech. What was the only story that mattered?
Chips, GPUs, NVIDIA. If you didn't own NVIDIA, you lost money.
Right, because the entire world was building infrastructure. It was the gold rush, and NVIDIA was selling the shovels. Everyone needed H100 chips to build their data centers.
But the argument now is that the shovel phase is peaking.
Exactly. We've spent hundreds of billions on chips. The data centers are built. Now the question shifts. The CFOs who spent all that money are asking, okay, we have the chips. What do we actually do with them? Where is the value?
We're moving from the hardware layer to the application layer.
That is the NVIDIA moment for software. The analysis suggests we are witnessing the baton pass. The value is moving from the people who make the chips to the people who make the chips useful.
And Palantir is positioning itself as the operating system for that utility.
Correct. If you have $1 billion of compute power, you need a platform to organize your data so the AI can actually use it. You can't just plug a chip into a spreadsheet. Palantir argues that AIP is that platform.
So if this theory holds, Palantir isn't just a successful company. They are the leader of the second wave of the AI revolution.
That's the thesis. NVIDIA owned the first half. The second half belongs to the application layer. And right now, with a score of 127, Palantir is the only application company putting up numbers that justify the hype.
It is a staggering thought. It reframes the whole conversation from, is this stock expensive, to, are we entering a completely new phase of the tech cycle?
Precisely. And in that new phase, the old metrics might not apply. Palantir has effectively decoupled itself from its peers. They aren't competing with Snowflake or Datadog anymore. They are racing against their own ability to scale operations.
So to wrap this up, we have an impossible score of 127. We have a sales cycle that has compressed from months to days via boot camps.
Right.
And we have a potential macro shift where value flows from hardware to software.
It's a perfect storm. It requires a lot of belief in the execution, but the data, the hard numbers, suggest this isn't smoke and mirrors. This is an engine firing on all cylinders. I
want to leave our listeners with a final thought to mull over. We've been staring at this 127% score as if it's a peak, as if it's the finish line of a sprint. But I want to go back to that second wave idea.
Go on.
If the application era is truly just beginning, is 127 actually the starting line?
That's a scary thought for the competition.
And consider this. In a world where sales cycles drop to 5 days, what happens to the legacy software companies who are still operating on the 9-month timeline?
It's simple evolution. If you're taking 9 months to close a deal while your competitor does it in a week, you aren't just losing a sale, you're losing the war.
You become extinct.
You become extinct.
Adapt or die. We'll be watching closely to see if Palantir can keep up the pace next quarter.
It's going to be a very interesting summer.
Thanks for diving in with us.
Always a pleasure.
Don't forget to like, share, and subscribe for more.